What's up you guys, welcome back to the Options Income Strategies channel here. In this video, I'm going to talk to you about how to double your money in the stock market. So first, I'm going to discuss two different strategies here. One is the buy and hold strategy, where you save up a bunch of cash and invest it in a particular stock or an index and hold it for a period of a few years or a few months, however you want to invest it. And the second strategy would be using options and how you can invest money on a monthly basis or every few months and be able to double it over time. Okay, so for the buy and hold strategy, there's something called the rule of 72 that determines how many years it takes for you to double your money. Okay, so the rule of 72 states that if you divide 72 by the number of years you want to double your money in, then that determines the approximate average annual return you need to double your money in that many years. And now, just based on this formula, this also works conversely, which means if you're aiming for a certain average annual return, this formula can help you calculate how many years it would take for you to double your money. Okay, so for example, if you want to double your money every 5 years, you divide 72 by 5, which gives you 14.4%, and that's the average annual return you would need to double your money every 5 years. Okay, so say you save up $10,000, invest it in a particular stock, and just don't do anything for 5 years. And if that particular stock returns you 14.4% every year, then 5 years from now, that $10,000 would turn into $20,000. Okay? As I said below, conversely, if this is your return, which is 14.4%, then it would take 5 years for you to double your money. Now, this is a relatively rough approximate because it's mainly accurate between 5 to 25%, because that's generally the average annual return that most people can achieve. And so for our purpose here, this is a pretty close enough approximation that you can take to determine how many number of years it's going to take for you to double your return. Okay, now what I'm interested in particular is actually options investing. But before I get into that, I wanted to show you a few more examples so you can visualize how this formula works. So here's a table I have where if you actually use a compounding interest calculator and use the average rate of annual return, it shows you the actual number of years it takes for you to double your money and how it compares to the rule of 72. So as you can see here, between 5% and about 25%, the approximation is very close. But below 3% or 2%, the difference is just way too high. Okay, so that's why I mainly wanted to focus on this bracket here between 5% and 25%. Now, getting to option strategies, the strategy that I'm going to talk to you about is called a call debit spread. Now, if you watched my previous video about the basics of options trading, then I've already gone over what call debit spreads are and how it's one of my favorite strategies that I use to get exponential profits irrespective of how the stock price moves. Okay, so just to give a quick recap, a call debit spread involves buying a call with a lower strike price and selling a call with a higher strike price. Okay, call debit spreads are bullish strategies where you're betting that the stock price will stay above a certain break-even price and you will make the full profit as determined by the options prices at the time of expiration. Okay, now the advantage of a debit spread as opposed to a credit spread is that you don't need any cash collateral in your account as a hedge for your losses. And your maximum loss is only the debit that you paid to open that spread. Okay, so credit spreads are great in one way because you actually get a credit for opening a particular spread, but then your brokers will always hold $1,000, $2,000, or $5,000 as collateral until expiration date. But you don't have to worry about that in a debit spread. Okay, so depending on the break-even price, call debit spreads will allow you to lock in exponentially higher profits even if the stock price doesn't move much. And I'll give you an example of how that works even if the stock price doesn't move. Okay, now to double your money on a debit spread, all you need to do is find strike prices where you can purchase the spread for half the difference of the strike prices. I'll show you an example where this becomes more obvious. So let's say, for example, if you have a stock trading at $280 and you decide to open a debit spread where you have one call at $280 strike price and another call for a $285 strike price, and that the debit spread to open is worth $2.50 per spread. Now, since an option represents 100 shares, it's actually $250 to open one debit spread. Okay. Now, at all prices at or about $285 on expiration date, the price of this spread would be worth $5 because at $285, this particular strike or this particular call would expire worthless, and this call would be worth $5. Okay, and then you essentially turn this $2.50 into $5, and you would have doubled your initial investment. Okay, if the price goes to $290, this call would be worth $5. This call would be worth $10. Difference is again $5. Again, in which case you would turn $2.50 to $5 again. So that's why I say at every price at or about $285, you would have doubled your initial investment. Okay. Now the key to this strategy is to make sure that you find a relatively undervalued stock and at a far enough expiration date so that any volatility in between will not derail your strategy. Okay, so if you found a stock that has already gone up a lot, there's a good chance that somewhere between now and expiration date, it might crash, or there could be some news about the company, or it probably just got too overvalued and the stock price might go down. And in that case, you might lose out on this debit spread. That's why the key to the strategy is to find relatively undervalued stock and find an expiration that could be maybe 6 to 12 months away, so that if the stock goes up even more, or whether it goes down and comes back up, it's still fairly close to where you bought it. And that way, you're far less likely to lose on that trade. Okay? So if say you make monthly deposit into your account, say $500 a month, you could try the strategy on different stocks, and by the end of the year, you could have easily doubled your money on several stocks. Even if all of them don't pan out, even if only 70 to 80% of them do, you'd have still gotten an exceptional annual return by the end of it. Okay. Now remember that options prices do fluctuate a lot between now and the expiration date, but the profit at the end is only dependent on the strike price on the expiration date. Okay. So for example, this particular stock that's trading at $280, if tomorrow there's some great news about it and the stock shoots up to $300, the stock itself has gone up $20, but just because of how options behave and how different call options can behave differently, your debit spread could have gone up 20%, or it could even go down 5%, or it probably didn't even move at all. Okay, so just because you see that your debit spread probably went negative even on the day that the stock price has gone up, you need to understand that it's all volatility, and the profit, you'll see the profit only on the expiration date. Okay, so you need to hold steady through volatility and just wait for expiration date. Now, if the stock does go up sharply in a short time and the debit spread also matches along with it and does reach a maximum profit, so for example, let's say for this particular trade, you set the expiration date for 6 months away, and you realize that within a month or two, this particular spread went from $2.50 to $5. Now you know that your maximum profit is capped at $5, so there's no need for you to wait till expiration to lock in the profit. So you can go ahead and sell your spread for $5, and you've just doubled your money. Okay. So that's all I had to share in the presentation for you guys. I wanted to give a quick example on an index fund that I've used the strategy on, and also some debit spreads that I'm implementing in my portfolio currently. Okay, so we're back at the optionsprofitcalculator.com that I referred to in my previous video. I'll link to it in the description again, but this will help you visualize how a debit spread will work and how you can double your money. Okay, so here I have VOO, which is the Vanguard S&P 500 Index Fund, and it's currently trading at $279.63. Okay, so let's say 6 months out, which is 15th January 2021, you buy a call at $280, and then you sell a call for that same day for $285. Now your spread is $5. You hit calculate here, and you see that the debit you use to actually open the spread is $270, and the maximum return you can get is $500, because that's the difference between the strike prices at $285 and above. And so the maximum profit you get is $500 minus $270, which is $230. Now that's about an 85.2% return. in just 6 months. Okay. Now, one thing you need to remember is when you're opening a spread, you could also choose to enter the limit price you pay for each of the calls. So let's say instead of paying $19.35 to sell this 285 call, let's say you put in a price for $19.55, and then you just turn your debit into $250 instead of $270, and that'll make sure you are actually doubling your money. Okay. So if you invest $500 a month, for example, you can start this spread for $500 this month, and by the end of the year or in 6 months, you would have turned that into $1,000. If you invest $1,000 a month, you can invest all the $1,000 at one go, and you would have turned that into $2,000. Okay, you can try this on multiple stocks, and it would work the same way. So let me give you an example of a particular spread that I have in my account right now. Now this is Delta Airlines here. I purchased this 24-26 call, the debit spread, just on May 19th, and as you can see here, I put in $390 to open the spread. Now between May 19th and June 14th, which is today, in less than a month, it has already gone up 66.67%. Okay, the maximum profit for this would be the difference between the strikes, which is $2, times the number of contracts I purchased, which is 5. So the maximum return I could get is $1,000 from it. And since I put in $390 to open it, the maximum profit for me is actually $610, which is slightly more than 150% return in 6 months. Okay, so in the next few months, since I already got 66.67%, in the next few months, if it actually does end up going to $1,000, I would actually sell out. There's no reason for me to actually wait till January 15th of next year to close this trade, and I would have 2.5x'd my money from this. I'll show you another example. So here's another example for Boeing stock. I purchased this particular trade on May 19th as well, and the calls I got were for $145 and $150 debit spread. Now at the time when I purchased this, the stock was only $134, but if you've been following Boeing stock, it actually has shot up a lot in just the last 1 month, and it went from $135 all the way to $189 today, even after the pullback we saw on Thursday. Okay, and in that short time, even this particular spread has gone up 53.85%. And because the difference between these prices is $5, and I have 5 contracts here again, the maximum value of this spread is going to be $2,500. And now that I'm already up to $1,500. So as at some point, if this does go up to $2,500, I'm going to close this trade and lock in the full profit of 156%. Okay, I gave this exact example in my previous video if you watched it, and I did implement that trade, and it looks like it's going to work out pretty well. As you can see, I can lock in this profit of 156% as long as Boeing trades for $150 or above before January 15th. The fact that it's already $189 practically guarantees that this strategy will work out, and I could lock in 156% profit on Boeing. Okay, let me show you one final example. Okay, here I have Virgin Galactic Holdings. If you've been following the stock, Virgin Galactic Holdings has been a pretty hot stock lately. They're into hypersonic flights, and they're into space travel. If you've been following that particular stock, this had gone up a lot last year. Initially, when it IPO'd, it went all the way up to $43 if I'm not wrong, and now it dropped back to only $15 approximately. So considering that it had gone up so much and it had come down, I was pretty confident that it would at least be $16 by January 15th. So I opened up this particular debit spread for a $16 debit spread, and I had 20 contracts here. So at every price at or above $16, this spread is going to be worth $2,000, and I put in $760 to open it. So that would again be 163% profit. Okay, if I get $2,000 for putting in $760. So as you can see, this is a really easy strategy to implement. You could do it on a monthly basis on different stocks. You could use the same stock if you wanted to, or you could use the same index fund to implement the strategy on. And even if the stock price is so close to where the stock is currently trading, you can still double or 2.5x your money depending on what your strike prices are. Okay, so that's all I wanted to share with you guys for today. I hope you enjoyed it. Please leave a comment below if you have any questions, or at least you can share what you liked about it, and hope that helped out. I hope you also had a great weekend. Please subscribe and smash that like button if you haven't already. Okay, thank you guys. Take care.